All right, guys, so here I am in Boynton Beach, Florida, and I'm with a good buddy of mine, Chris Igo, and it's been a long day. We're hanging out, and we started our new series of Highest and Lowest, our city tour. Tomorrow we're heading to Boca, and we're gonna be podcasting with another friend of mine, John Williams. We've had him on our channel a couple of times, and he set up a podcast studio, but we're really kind of sitting around talking. We just had some dinner. We're just kind of having like a little fireside chat about the market. So Chris, you and I are in a little different backgrounds, and you're from more of the financial side of things, and with being a stockbroker, and you ended up in real estate. I've been in real estate my whole career, serving the housing market in one form or another since 1989. Started out swinging a hammer, so contracted, and and we're kind of talking about this current market, right? The market, and one of the things that Chris was saying, well, how is this different than 2008? Because clearly we're seeing, a lot of similarities in sort of the exuberance.
You remember Alan Greenspan's famous quote where he described the markets as being irrational exuberance? It took me a minute there. Irrational exuberance. And that's what I think a lot of people are feeling right now in terms of lots of different things. And so another way of describing that, I think, would be called the wealth effect. So right now, at least in my market, homeowners are sitting on, and the term I like to use is a metric shit ton of equity, right? Now,
depends on when they bought.
It depends on when they bought, absolutely. But by and large, for the most part, unless it's within the last year or so, they're sitting on significant equity, and they're most likely in the mortgage at a very, very low rate, right? Now, I wasn't in the real estate market or the housing market the last time it crashed. I was a financial professional. So I got to experience in real time the devastation of walking in and seeing the markets down 500 points and then having so much volatility that they would pause the market and temporarily suspend the market.
What year was that?
I mean, it's happened numerous times throughout my career.
But when was it in relation to the bubble, the housing bubble of 2006?
So this was starting right around that same period, right?
Yeah.
But the bottom fell out of the stock market well before the bottom fell out of the housing market.
Right, but what happened was, and I know because I was building houses back in 2005, and we had the headlines of the Baltimore Sun said the overpriced Baltimore housing market. That was in the spring of 2005.
Right.
This is prior to the peak even of 2006 of existing home sales.
Right.
So it actually started, so what was happening was people were starting to take their money out of the stock market and they were putting it into real estate. I mean, everybody was investing in real estate, right? I mean, it was sort of like what we have now in leading up to 2022. We have, a third of home buyers year over year over year have been investors. So they're investing in real estate. But I was just kind of curious. So at what point did you see like the stock market, when you say the stock market crashed before the real estate market, what year was that, if you had to?
So when Bear Stearns failed, leading into that, we had all types of different policymakers, Ben Bernanke being one of them, talking about the structural stability of the system, making statements like the housing market is immune to a crash because it's never happened before in history. And so what I learned is that policymakers and government officials, they're never going to go out and freak out the market or panic the market. They're going to say whatever they must say in order to not freak out the market, right? So they're never going to tell you the truth. They're going to tell you what you want to hear. And today we're in an election cycle. So I've been talking about this for a while on my channel, and it seems to be factually true, but the data that continues to be reported seems to be underreported by a wide margin across the board on almost every meaningful metric. So you mentioned the frenzy that existed in terms of everybody was running from the stock market into the housing market, and the rebuttal that almost every real estate professional will say now is, well, in 2000, this market is different than 2008 because the loans are different and the financing is different,
right?
And the creditworthiness of the buyer has been approved. So we're not going to see a crash due to that. And that might actually be true. However, the unemployment numbers, which are vastly underreported, will cause financial stress.
Yeah, and so it doesn't matter, and that's my point, right?
Yeah.
Because we don't want, look, Chris, I've been telling everybody from the beginning when we started calling for the market to swing towards, the other way, which it did. I mean, we had the peak clearly in May, June of 2022. Some people want to say, and this is what gets me, is some people want to say home prices are still going up. But we're not seeing people spending $100,000 over appraised value anymore.
Right.
Right.
So rational thinking has come back into the equation.
So what happens, just that in itself, people giving up their contingencies and not getting inspections.
Right.
Getting inspections now, having financing contingencies in place right now, having no gap contingencies from appraised value and purchase price right now is a vast improvement from the housing market. And in essence, it is a type of a crash from the peak, okay? So now what happens is, and this gets me, because I don't want to be right. I don't want to see people lose their home. I don't want to see buyers overpaying and having remorse like they are, and having real estate claims to the real estate commission and epidemic proportion right now because because they're burned and they feel bad because now they can't afford to make the repairs. This is not fun place to talk about, and it's not that I want to be, crash oriented. But what you just said is the core. It's the core. The new buyers over the last 2 or 3 years are financed to the max.
Right.
They bought it at peak, right? I don't care about the people that don't have to sell that are 2 3/4% that have $100,000 in equity in their house.
Right.
They're not selling because they're smart. They're like, I don't want to sell. Why would I give this up and then get less for more? It's the people that ran this gamut. It's all of the buyers that ran this gamut, and they did so with little to no money down. And people want to sit there and say, oh, they put more money down than ever. No, well, that's just simply not true. What happened was their parents put down money, right? You know it, you've seen it. And then what happens is this, Chris, should anything happen to one of their, if it's 2 buyers, if anything should happen to one of their paychecks,
it's game over.
They're 3 months away from being in risk of foreclosure.
So the metric that people don't talk often enough about and might not even know about is debt to income. Right?
Yeah.
So during the underwriting process to get a loan approval, I've witnessed firsthand plenty of lenders that will manipulate whatever they need to in order to get the buyer to be qualified for the home.
Yep.
Now, you had just mentioned that the frenzy no longer exists where there's multiple offers and they're waiting.
Well, there are multiple offers, yeah. Well, I'm talking about the stupid spending, right?
Well,
I want to pay more for this house regardless of what it is because I want it. That's what was happening.
And that's still happening in some markets
today. Some markets, but not the first-time buyers.
No,
These are people that have equity in cash.
Right. So just to give you a real-time example, so you're here, you've driven through the neighborhood. There is not a lot of inventory to live in the communities that are similar to this, right? And so when there is one that's priced the right way, it's funny because I'm working with some clients right now, found me on YouTube, hired me to sell their house so they could buy another one. And we waited for the right home because it wasn't on the market. And so they found it. And literally within 5 minutes of being listed, I had reached out to the agent, scheduled the showing. He's like, we've got 50 showings for tomorrow. This is like within, I'm not making this up, 5 minutes of being on the market. And I told them, I said, look, despite everything that I've told you, which is true, on this particular home priced this particular way, tomorrow there's going to be a line around the block and it is going to be the frenzy. And so,
but that's pricing it right.
It's pricing it right. And yet those buyers who wanted that house in this neighborhood were willing, despite whatever the economic conditions are, they were willing to waive whatever contingencies they needed to in order to get the home that they want.
And these are repeat buyers, most of them?
Yes.
Yeah.
Yeah.
So they've bought houses before, and I don't really, I mean, you probably don't worry too much about them either. I mean, if they have equity and, you know, they have wealth, I mean, they've done pretty well for themselves. I mean, what's another $50,000 or $60,000 to get what they want, right? And so they look at it that way. But I'm not concerned about them as much as I am concerned about, you know, the person that's renting right now, or the couple that's renting, and they want to get married, or they are married and they want to have kids, they want to have a family, and they can't afford to be in, I mean, back home in Maryland. I mean, I've said this on the podcast before, my podcast, you know, I have buyers right now that would love to buy a home up to $550,000. They need very little criteria. They need 4 bedrooms. Right? And they need 2 baths. They're not looking for, you know, en suites and craziness stuff.
They want a home.
They want a home, right? They want stability. They want to be and put their kids in a school that they can, you know, grow up and things like that. But we have a search going for them, Chris, over 5 counties. And they don't want to be in Baltimore City, so it kind of wraps around a very big swath. And there's like 7 houses, 8 houses. Yeah. That's it. And of these 7, 8 houses that fit this criteria under $550,000, I mean, they need work, man. You would look at these and go like, I wouldn't buy it for $550,000. And that's why they're sitting.
Yeah.
That's why they're sitting. But they would need to bump up realistically another $100,000. Yeah. $650,000 for a house. That's still a very sweet spot in Maryland. We're going to get multiple offers on that. It's going to sell for over list price. And there will probably still be contingencies, but they're going to be like this. Okay, you want an inspection. Well, if we accept your offer, we want you to agree that you're not going to ask for anything that's less than $10,000. Fair enough. If that's cool, because we don't want to be nickeled and dimed. Right. We want the big stuff. We want to talk about the big stuff. And you know what? Those buyers are going to go, deal. Yeah. They're going to say, deal. We're not going to beat you up on the little stuff. Yeah.
Well, you started by saying that you're not concerned about the more affluent buyer, right? And so, number one, I don't want any of these things to come true. It's not like I'm looking for the market to crash, or I'm rooting for it to crash, or the economy to fail, or any bad thing to happen. Nobody wants that. It's just impossible for me to ignore when I see the setup in. So I feel a personal fiduciary responsibility to make sure and be concerned about everyone, irrespective of whether they're wealthy or not wealthy. I want them to know exactly what we're talking about as of today. And so the lagging market indicators that are irrelevant when you're shopping today don't mean anything. And yet, I find a lot of people, that's all they want to lead with, that's all they want to talk about, and they're misinforming the public as to the reality of what the housing market is. So when I'm doing a buyer consult with somebody that I don't know that hires me to help them buy, whether it's a $400,000 home or a $40 million home, it's the same questions. They're the same people. You know, the amount of zeros in the bank account is irrelevant to me. Here's what we're looking at in terms of, again, I'm not an economist, I'm not an analyst, I don't pretend to be, but I do have common sense, and I have seen this movie before. I know how it ends. So, okay, you want to buy this home. Well, here's what I suspect will likely happen in the near term based on my experience. And I tell them the truth. And then separately, if you were to buy this house today, and let's pretend, which it's impossible for this to actually happen, but you buy your dream home, your dream lifestyle, you can afford it, you've checked all the boxes, and you're satisfied this is the right decision financially for you, and you pull the trigger, you buy the home, and then the next day, the market goes to zero, what's actually changed about the home that you chose to buy? Nothing. You can still afford the home based on your own research, not my due diligence. I don't know what your personal situation is. But if it was to go to zero tomorrow, at some point in the future, just based on the fact, especially in my market, there's no more land to develop, there is a limited supply of homes available, and demand over time, supply and demand are going to do their own thing. So although that all-time high that you bought at went to zero the next day, at some point in the future, I don't know what that is, I'm not qualified to make an estimate on what it is, but let's call it 10 or 15 years, that house that went to zero is going to trade at a new all-time high just based on
history.
Yeah.
And I agree. I mean, I had no doubt about it. It's permanence of investment. I mean, over time it does climb. the big thing is, and we know, is that they need to stay there for the 10 years.
Can you stomach the volatility?
Right. So, and a lot of people, and this is what I see with especially the young people, is that they don't realize, like, a 10-year commitment to live in the same place. They're like, yeah, no, I don't want to do that. And that's what you're right. We have to make sure that we're educating them and say, look, you may not be able to sell this house unless you make a boatload of money.
Right.
We're in Florida, I can say that, boatload.
Yes. Yeah.
And, I saw some big boats today that had some boatloads of money. Yeah. But yeah, they might have to bring money to the table to get out. The guys, so look, I mean, Chris and I, we could talk all night, but if you haven't checked out his YouTube channel, you should do so now. And we're going to link it too in our video. And he just posted something tonight too. We were walking through this really nice house. You guys should check it out. And we love you. We appreciate you. We are so thankful that you tune in, watch our videos, guys. If you haven't done so yet, please consider subscribing to our channel and smash that alert bell. You'll know every time that we upload content just like this. You let Chris and I know you like the video by hitting the thumbs up.
Absolutely. Yeah, we love you. Please watch, subscribe. And if you have any content requests, please leave them on my channel. I read every comment. I will not respond to them unless you are on Twitter, in which case, follow me on Twitter and I'll reply to everybody.
There you go. See you next time.
Peace.
Sachs Realty, Maryland broker number 607720, office number 443-318-4514, equal housing opportunity.